The share price of the company I'm looking at today rose from £1.60 to £7.60 in 7 months, from August 2022 to March 2023. That's a 350% rise when most other stocks were suffering in the bear market. However, since hitting those highs in March, it's dropped by 40%. But this week, the company released a bullish trading update and the share price has started to rally again. The question is, can it surpass those previous highs? Let's have a look. If you hadn't guessed it already, the company is U Group. And like I said, this is a chart there, 375% up. And this is most stocks were going down this way in the bear market. But since March, it's dropped a bit. But look at this here, they're starting to rally again. Okay, that's the trading update. We'll look into that in a bit. But what do they do, first and foremost? Let's have a quick look. So delivering utility, driving innovation in business utility supplies. Okay, so they deliver clean energy, significant market opportunities there, driving innovation in business utility supplies through utility simplicity, strong systems, an experienced team, clear strategy for growth. What makes them different? Unique multi-utility offer, sustainable solutions, good customer service, flexibility, innovation digital, and their customers there. They supply gas, electricity, water, EV charge points, meter installations, energy efficiency, and they say we serve. Okay, so the trading update that's seen the rally start here. Okay, they say the group is pleased to announce continued strong trading and momentum with key performance indicators of revenue, profitability, and cash generation all showing very strong growth. That's what you want to hear as an investor. They go on to say revenue, margins and cash flow for the year to 31st December 2023 are now expected to be substantially ahead of current market expectations. And we're in June. So to hear that now, midway through the year, is very encouraging, gives a lot of visibility to investors. Okay? And like I said, this is the result. On one day, it went up 25%, and it's gone up again the next day on that trading update. Okay, so let's look into the spreadsheet because I've got it up here and I've gone through it. I plugged all the figures in my figures chart here, and it brings up this informational part here. So this is the full year results. This is half year results. Okay, this is up to June last year. This is up to December, the end of the year. So share price 616, market cap 102 million, enterprise value 83 million. It's in green, that's less than the market cap. What does that mean? They have more cash than debt. That's a good sign. That's why it's in green. These automatically color code when good figures come up. Liquidity is very good generally, about 340,000 a day. It's good sort of micro cap stock. So even 10% of that, is 33,000. If you're looking to get in and out, revenue 278 million. Operating profit loss 5.9. Now worth comparing here because up to the half year, 30th of June there, they did 5.5. Okay, so you'd say the first half of the year is obviously much of the contracts announced there. In fact, yes, it's not half split, so worth looking at that. But cash of 18.9, that's gone up. That's good. No debt. That's always a good sign. Operating cash flow, and there's a lot of people who just say that's all a business is really about, generating cash. You can't really argue that, but look at that. They generated cash from operations of 14.7 million, free cash flow, that's after investments as well, 12 million. So it's good. They've got a little bit of a dividend, half of 1%, and decent cover on that as well. Now, as I always look for growth, value, health, efficiency, momentum, and then looking at also forecasts going forward, because of course the share price is about that as well. So growth, excellent growth, top line 79%, and even half year 96%. Operating profit growth 70%. Net profit growth 7%, but it's still going in the right direction. Operating cash flow growth 2004%. Free cash flow growth 370%. This is where you want to be in a company, starting to increase that cash coming in. On a valuation perspective, price to sales, look at that, 0.3. Price to earnings, okay, it's a little bit higher, and you can start to work out now with we'll get to efficiency in a bit. But you can start to work out maybe with that amount of revenue, the margins aren't that big, okay? Because you can see it's 22 times on a PE level. Price to book 6. EBITDA is okay. So listen, it's below 15. Price to free cash flow again below 10. All good metrics. Health wise, very healthy. Net increase in cash. They got net. We know that no debt. So there's no worry about covering debt there. Current ratio very good. They can cover their current liabilities with their current assets. And a quick ratio is not quite there, but that's a high bar to set, that one. So let's look at efficiency. How are the margins? And it's the first time we see some pretty much red on the screen, and it is about the margins, okay? So gross margins, 15, 16, operating margin. They did say in their trading update, these will get better. So that's a good sign. It's a positive sign. Net margins, remember, they are turning over a lot. So it's almost like, there's not a lot of margin there. If they can improve that margin, we're good. But nevertheless, return on capital employed, that's a very good figure. 39, 40%, 61% for the half year. And as far as momentum is concerned, we're looking very good here. It's above most moving averages. So we'll look at the chart. So let's look at the chart here. And in fact, let's put these moving averages on. 125, I quite like that. I quite like the 20 as well. So you can see now it's above pretty much all the moving averages again. It did dip below. And you see here, it was a sort of level of support there. Charts, I mean, I don't believe in the predictability of charts. I look at them from a buy, sell, supply, demand issue and see where the price action's going. But you can see here, 480 odd. There was £5 pretty much. You say £5, 480. There was support. It sort of broke up strongly here, then bounced and touched it up here, and then bounced and touched it again and again, and bounced right back up. So this looks like now almost at 656, almost a bit of resistance there maybe. And it broke down strong through there. It had support there, and had a bit of resistance where they gapped up through it, filled the gap, went back up. But it's looking good. The RSI is above sort of 55, which is very good. 55, 60, that's when the momentum starts to kick in. And in fact, if you look back here, when it really starts to motor is when the RSI gets above 60. Be careful, though, of buying any stock above 70, 80 on the RSI. It very rarely hangs around at that level. It has to come back over 80. It may have to go sideways and then power up again. Okay, but I'm liking that, the spreadsheet. Let's go back to the spreadsheet there. And let's look at the scores here so far. In fact, I'll get back to that in a bit. But forecast-wise, okay? Now, these are forecasts from brokers. I plugged them in along with the improving margins. But in fact, I should improve the margin here a bit. So let's say pre-tax gets up to 3, maybe 4. Who knows? But let's look at the returns, okay? So, based on this revenue growth, 40% for 2023, 15% for 2024, and 10% for 2025. Of course, the bigger you get, the harder it is to get that huge percentage increase in growth. So that's where they have to start improving their margins there, because it's okay if top line stay there. But so based on the margins of 4 EBITDA, 3 post-tax, and around at 3 post-tax as well, and these multiples, 0.4 sales, 7 times EBITDA, 15 times post-tax profit, this is what you could achieve. So we're looking at, by 2025, 98% return, okay? And 56% this year, 98%. So we're talking about 12.20 a share. So it will get above, those previous highs if they keep churning out those kind of figures, and we're looking at those kind of margins and those multiples. Okay, let's have a look what the brokers say though. 2 brokers saying strong buy there, and they've got targets of pretty much, like I said, 10.40, 10.20, and they've got 2 analysts offering price maximum of 10, a minimum of 10. So around about £10. That's 1 year target. So where are we now? Yeah, 24. I suppose that's pretty much right for what I'm doing. So in summary, I'd say this is, it's a cracking start. They've done very well. And growth scores 95% out of 100. Value, very good, 87%. Health, very good. The only issue is, like I said, with efficiency. Return on capital is good, but their margins are slightly thin. But they're saying they're looking to improve that, and I assume they will, because they're still sort of growing and still investing in the company. So I assume those will get improved. Forecast, that's fair enough. So you're getting 76% score, which is in the green. That's very good. So my liking, and I give you a group a thumbs up.